Welcome to our new IFRS Insurance Fund series. It's an initiative of OJ Education Limited. It's dedicated to providing complementary and supplementary education on international financial reporting standards IFRS through a multiple choice question and answer approach. It is intended to make self-evaluation fun. In this session, we shall be considering cumulative set 210 questions to which the answers are provided on IFRS 9. This is the standard on financial instruments. Viewers or subscribers have 30 seconds to select or choose their answer to each question. The answers to the cumulative 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 11. Where a transfer of asset does not result in due recognition because an entity retains substantially all the risks and rewards of ownership, the consideration received is recognized as A or as an A. Income, B. Expense, C. Financial liability, D. Equity, E. Financial assets. Some counts. 10 seconds gone. 20 seconds gone. Timer. Question number 12. In subsequent period for asset transfer that is not recognized and for each consideration is received, A. Income on the transferred asset is not recognized. B. Expense on the financial liability is not recognized. C. Income on the transferred asset is presented net with the expense on the financial liability. D. Expense on the financial liability is recognized. E. Associated financial liability is derecognized. Some counts. 10 seconds gone. 20 seconds gone. Timer. Question number 13. When an entity's continuing involvement takes the form of guaranteeing the transferred asset, which of the following is not relevant? A. The amount of the asset. B. The guarantee amount. C. The historical cost of the asset. D. All of the above. E. None of the above. Some counts. 10 seconds gone. 20 seconds gone. Timer. Question number 14. To the extent that the transfer of asset does not qualify for the recognition, A. The transferee recognizes a receivable from the transferor. B. The transferee recognizes a receivable from the transferor. C. The transferor recognizes a receivable from the transferee. D. The transferor recognizes cash for the portion of consideration received. E. The transferee recognizes the transferred assets. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 15. A financial liability is extinguished when a debtor A. Discharges the liability by paying the creditor. B. Is legally released from the debt by the process of law. C. Is legally released from the debt by the creditor. D. All of the above. E. A and C. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 16. The difference between the current amount of financial liability extinguished and the consideration paid is recognized. A, as adjustment to fair value reserve. B, in profit or loss. C, in other comprehensive income. D, directly in retained earnings. E is ignored. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 17. When the transfer of an asset does not lead to the recognition, it implies that the A, asset is not owned by the entity involved. B, asset does not exist in the books of the entity. C, entity retains substantially all the risk of the asset ownership only. D, entity retains substantially all the rewards of the asset ownership only. E, entity retains substantially all the risk and rewards of the asset ownership. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 18. If a transferred asset continues to be recognized, the asset and associated liability are A, always offset, B, sometimes offset, C, never offset, D, derecognized, E, carried at their historical cost. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 19. On the provision of non-cash collateral, where no default arises, D, A, transferor derecognizes the collateral. B, transferee recognizes the collateral. C, collateral is reclassified as liability by the transferor. D, transferor continues to carry the collateral as asset. E, transferee continues to carry the collateral as liability. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 20. If a transferor provides debt instruments as collateral, the accounting for the collateral depends on whether A, the transferee has the right to sell the collateral only. B, the transferee has the right to reply the collateral only. C, the transferor has defaulted only. D, all of the above. E, A, and C. Time counts. 10 seconds gone. 20 seconds gone. Time up. We proceed to review the answers. Question number 11. The answer to question number 11 is C, financial liability. C, financial liability. Where a transfer of asset does not result in due recognition because an entity retains substantially all the risks and rewards of ownership of the transferred asset, an entity recognizes liability for the consideration received. C is the answer to question number 11. Question number 12. The answer to question number 12 is D. Expense on the financial liability is recognized. D. Expense on the financial liability is recognized. In subsequent period for asset transfer that is not derecognized, an entity recognizes income on the transferred asset and any expense incurred on the financial liability recognized on the consideration received. D is the answer to question number 12. Question number 13. The answer to question number 13 is C, the historical cost of the asset. C, the historical cost of the asset. When an entity's continuing involvement takes the form of guaranteeing a transferred asset, the extent of the entity's continuing involvement is the lower of 1. The amount of the asset, and 2. The maximum amount of the consideration received by the entity that the entity could be required to pay, which is the guarantee amount. The historical cost of the asset is not relevant in this regard. C is the answer to question number 13. Question number 14. The answer to question number 14 is A. The transferee recognizes a receivable from the transferor. A. The transferee recognizes a receivable from the transferor. To the extent that a transfer of financial assets does not qualify for derecognition, the transferee recognizes the cash and other consideration paid and recognizes a receivable from the transferor. A is the answer to question number 14. Question number 15. The answer to question number 15 is D, all of the above. D, all of the above. A financial liability or part of it is extinguished when a debtor either 1. Discharges the liability or part of it by paying the creditor, or 2. Is legally released from the primary responsibility from the liability or part of it, either by process of the law or by the creditor. D is the answer to question number 15. Question number 16. The answer to question number 16 is B, in profit or loss. B, in profit or loss. The difference between the current amount of a financial liability extinguished and the consideration received, including any non-cash transfer or liabilities assumed, is recognized in profit or loss. B is the answer to question number 16. Question number 17. The answer to question number 17 is E. Entity retains substantially all the risks and rewards of the asset ownership. E. Entity retains substantially all the risks and rewards of the asset ownership. The non-derecognition of a transferred asset by an entity implies that the entity retains substantially all the risks and rewards of the asset ownership. E is the answer to question number 17. Question number 18. The answer to question number 18 is C, never offset. C, never offset. If the transferred asset continues to be recognized, the asset and the associated liability are never offset. C is the answer to question number 18. Question number 19. The answer to question number 19 is D. Transferor continues to carry the collateral as asset. D. Transferor continues to carry the collateral as asset. Where the transferor does not default under the terms of a contract, the transferor continues to carry the collateral as its asset, and the transferee does not recognize the collateral as asset. D is the answer to question number 19. Question number 20. The answer to question number 20 is D, all of the above. D, all of the above. If a transferor provides non-cash collateral to a transferee, the accounting for the collateral by the transferor and the transferee depends on whether the 1. Transferee has the right to sell the collateral, or 2. Transferee has the right to replace the collateral, and 3. Transferor has defaulted. D is the answer to question number 20. That is all for this set 2. Thank you for joining us for this set 2 of IFRS 9 Financial Instruments. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standard in this framework and create other sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and all that's in the service are reserved for OJ Inspiration Limited. Thank you once again and bye for now.